Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we're going to be analyzing Texas Instruments stock. I've had several requests for this one down in the comments section of my other videos. If you have a request you would like me to analyze on the channel, just put it down in the comments section. If it's a stock that's in the S&P 500 like Texas Instruments is, I post those on YouTube for free. The rest I post on Patreon. Which is $5 a month, and then in the full Cyclical Investors Club service on Seeking Alpha. Those links are down in the description, and if you join Patreon, you can get a big discount if you ever decide to join the full Cyclical Investors Club service. So as always, this is not individual investing advice. This is just how I analyze stocks. I did do a analysis several months ago on Texas Instruments. I think I used a dividend analysis, which I'll cover again here. But normally I would just refer people back to that video, but there has been some updates and changes to the earnings that I thought were interesting. So I'm going to, just review it and go over it again from quite a few different angles because it's a really interesting stock. So I've never bought this one yet. I don't own it, but it covers kind of three different categories of stocks. All the three types that I basically talk about on the public YouTube channel here. It's a pretty good example of how you can use dividend sometimes to value a stock if it meets certain parameters. It's also a good example of how you can use earnings as long as you would make adjustments for earnings fluctuations and earnings cyclicality. And it's also pretty much, especially at this point, kind of a deeper cyclical stock as well, or it can be at least. So it straddles the line of all these different types of ways you can look at it. And it just makes it interesting. There aren't really too many stocks like that. I think right now, what we see here is, let's zoom into the fast graph. I do have a 25% off affiliate link for fast graphs down in the description. If you decide you want to ever try it out, I've used this I just got the links recently, but I've used fast graphs for like 6 years now, probably, or more. And it's really useful for doing these type of earnings analysis. And then I also use it a lot in my initial categorizing of what types of business something is. Usually I do that based on their historical earnings pattern. So this shows me what those are really quickly. And if we do that, before I zoom in, I'll zoom back out. We can see this dark green area is Texas Instruments adjusted earnings per share. And what I like to do is look for any big drawdowns. So they drew down about earnings, the green area here, drew down about 40%, give or take, during the Great Recession. And then another 40, we'll call it. Just after that, they had one big up year and then another decline. So this I would describe as moderately cyclical earnings. If they're bigger than like 50%, then I basically put them in a whole different cyclical category of stock. And I do a different type of analysis for those, because when earnings fluctuate a lot, it can be really hard to do an earnings-based analysis. It can often send you the wrong signals. So as an example here, if you look, Texas Instruments at the bottom or near the bottom of their earnings in 2009, they were trading at 22, I'll call it a 23 PE. Well, if we go back over here before the stock price fell, they were also trading at a 22 PE, or give or take, right? So the difference between then and here, if I just go back to kind of where it was 22, and again, I'm not picking the bottom of this down cycle, is 30%. So, and the reason for that is because earnings had fallen 30 to 40% during this time, right? So it would have looked like the valuation was the same if you were buying it in 2009 than if you were buying it in 2007. But because of these earnings fluctuations, it wasn't. It was a much better time to buy in 2009. And so for those reasons, if these earnings were even more cyclical, then it would be an even bigger discrepancy. And that's why I don't use earnings for deep cyclical stocks. But historically, they haven't been really deeply cyclical. So as long as we adjust for these slow earnings years where earnings growth declines and we make adjustments for that, we can do a normal earnings-based analysis. Now, most analysts, maybe all of them, but me, honestly, I don't know if I've seen anybody that makes the sort of adjustments for this cyclicality, for this moderate cyclicality that I do. It's one of the things that kind of makes what I do unique, right? So I'm usually going to be more conservative on my earnings growth estimates because I take these downturns into account. Now, what's interesting is when we look at today, we actually have a deeper now this is what analysts are expecting for this year for earnings. They might be being too negative. We don't really know. Often with more cyclical businesses, analysts make bigger mistakes when it comes to predicting future earnings, right? Even if it's only in the year. So we want to be a little bit careful about that because we don't know what these earnings are going to be. But generally speaking, we're looking at almost 50% decline or 45% decline from their peak of $9.41 a share. So what's important to point out about this is really a boom bust from the pandemic. So we had pandemic stimulus, we had demand for, all the remember we had a semiconductor shortage, all the stuff. Texas Instruments, part of their business, making equipment to make semiconductors. So we would expect that they would see more demand for their products, which they did, and they get these big earnings boosts. And now we're having, since that was kind of pulled forward as a way you can think about it, now they don't have as much demand and earnings are falling. So, but that doesn't mean there's anything wrong with the business, right? So often when this happens, the market will overreact a little bit and they will send the stock price significantly lower, which is what we saw. Actually, so we can see that earnings, this is the same size of earnings decline that we had in 2008, right? And the PE was pretty similar, even up here near the peak, we're like 23, 24, okay? So the PE was pretty similar going into this earnings decline. But the stock price, let's just pick a 22. Yeah, right. We'll pick almost the same PEs. But the stock price has only declined 8%. We'll call it 10%, roughly, from near the peak. Now, if we go back to 2008, remember, earnings are falling the same amount. They started with a little bit higher valuation, actually, during this bust, right? But in 2008, if we were to track how far the stock fell, it fell about 65%, okay, off its rough high. I'm just roughly picking the top and bottom. So if you went by the daily, you can see this is 39 and 13. Yeah, about 65 is what you're looking at. So the stock fell 65% the last time earnings did this. This time it's only fallen 10% so far. So why is that? And that's a great question. I think part of the reason is that Texas, there's a lot of demand. I know I say this in so many videos, but it's so true. There's a lot of demand for steady paying dividend stocks. And I think a lot of people that are in those types of stocks would really like to have some technology companies in those stocks, which is probably why, Facebook and Microsoft and Apple have kind of gotten into, or Meta, I guess, have gotten into that now with their dividends. So they're kind of getting into this dividend investor group a little bit. But Texas Instruments been paying a dividend for a long time, and it's also in kind of the tech / semiconductor business. And so it makes it really attractive with a 3% dividend yield, which might be double the S&P 500. Let me check real quick. I haven't looked at. So S&P 500, yeah, more than double. I mean, so significantly higher, even at these current prices. So you get a 3% dividend yield here. You get a well-known brand. Texas Instruments has been along for a long time. So even retirees, which are the people that have the most money in society, most investable money, they're going to be familiar with it. They're going to feel comfortable with it. They're going to look at this dividend streak, and they're going to buy it. A lot of people are buying it for the dividend or have bought it for the dividend. And it's kind of a unique prospect in that sense. So my theory here is twofold. The main one is that there's a lot more buy and hold dividend-oriented investors that have bought this stock over this cycle compared to 2007 or whatever. And they're much slower to sell a stock even if earnings are falling 50, like almost 50%. So, and these earnings actually haven't totally fallen this far yet. We don't. So this is just a guess by analysts, I would say. What I find interesting right now and would probably be worth doing deeper research on. I don't usually do super deep research, but this one makes me curious enough I might. What we've seen with AMD, Nvidia, more recently Micron, which I sold right before this last 20% rally, is kind of this AI boom in certain semiconductor businesses. It would be interesting to see how that might affect Texas Instruments and if they can benefit, how much they could benefit specifically from the AI boom that's going on. That could also be holding up the stock price a little bit more than one would normally expect. I don't know if it's fully justified yet because I haven't really done the type of research a person would need to do to know the answer to that. I mean, to some extent, we don't know the answer, but we know how the market's treated some of these other businesses. And so it's possible investors are waiting maybe for the next earnings report or two. I would say when you're more of like a semiconductor supplier, those benefits can be delayed more because you need the semiconductor folks to have the demand for the machines and everything that like make semiconductors. So, and I don't know, I know enough about Texas Instruments to know that's part of what they do, but I don't know exactly the precise what each thing that they do does or anything. Haven't dug into that, but a person might want to in this case. So that's a big setup really for, so how do you go about analyzing this? Well, I think I've had a hold pretty much on this stock always. I don't think I ever wrote a sell article on it that I can remember. I should probably double check that, and somebody might. I think I've kind of always had a hold. There's been times where it got close to me buying it, I know, or at least enough for me to be interested in it, but it never really got really close. So that's a big context for kind of what we're getting into now. So I'm going to do a dividend-based approach. And the reason that is useful is because these earnings fluctuate so much, but not a ton, the dividend is very steady. And a lot of times, if it's management of a good business like Texas Instruments, they'll kind of know the cyclicality of their business. They'll try not to get too crazy on dividend hikes because they want to be able to pay those in the down cycle and keep their streak going, kind of be responsible with it. So this is one of those cases where you really can kind of look at the dividend and get a view for what management thinks the future averages are going to hold. And then if you look at the stock price relative to that, so when the stock price comes down, the dividend yield will go up. That can give you a read on the valuation, right? So I have a dividend approach called the dividend time until payback. This is how long it would take you to earn your money back via only the dividend and the dividend growth over time. So the way I calculate this, so this number is their actual dividend growth, or it was when I last updated this. You can go into fast graphs here, and this is another thing that it's pretty useful for. Let's see, we want performance. And I think it'll take the time. Let me get the time period right here. 2023, okay. So I had it at 18%, I think, in my spreadsheet. Here it's 17.31, so it's come down just a little bit because more recently, I think they actually have a breakdown of it here too. Yeah, we can see. So last year it only grew 7%. You can kind of see the trend where there was fast growth. It slows, slower, right? So that dividend growth was growing pretty fast during this period at first, but more recently it's coming down, which is exactly what I would expect because when I do my earnings growth analysis and I control for all the down cycles and everything that I like to control for, they really only are growing earnings at about 6%, like a little under 6%. Here's my estimate, which is adequate, but it's not fast. It's definitely not 18 or 17%. So what happens is that when there's a lot of space between earnings and the dividend payout, then you can grow dividends faster than earnings for quite a while. But over the very long term, as we see, it's going to take 20 years to earn your money back from the dividend right now. The earnings growth rate is a cap on how fast the dividend can actually grow long term. And with the dividend only growing 7% last year, it's actually very close to this earnings growth rate. So the way I do it is if the payout ratio is over 50%, I use the earnings growth rate as the expected long-term dividend growth rate. If the payout ratio is under 50%, then I average these two together. And that would give me kind of a rough read on how much that includes some of the space they have to increase the payout ratio, and it includes some of the cap that they have in terms of slower earnings growth. So they will converge over time usually, if all other things being equal. So because earnings are so low right now during this down cycle, the payout ratio is like 99%. So now they expect that they won't stay down there forever, right? That earnings will eventually recover. This will lower a little bit, but it probably won't lower below 50%, right? So I assume the dividend will grow at about 5.64%, which is actually pretty similar to the 7% it grew last year. And I basically take the dividend, I grow it at this amount, and I think about how much money you'll actually collect over that time. This isn't reinvested, so if you retired or you owned a whole business like this, you could take that money and go spend it. This doesn't assume that you're reinvesting that dividend, because some people in retirement will spend it. I don't think it makes sense to do a dividend analysis where we assume the dividends are going to be reinvested, especially since a lot of people will probably have to pay tax on those dividends. So when that's all said and done, without taking you through the whole process, it looks like if these assumptions are right at the price today, take about 20 years to earn your money back from the dividends. To me, that's a long time. I like it to be 10 years before I would consider buying something just for the dividend. 12 years, I think most normal dividend investors would be pretty happy with that. So yeah, like 12 to 15 would probably be like a hold range, and then when you get above that, things are getting more overvalued on an absolute basis. And that's just my personal scale for strict dividend investing. Now, on a relative scale, I like to compare dividend growth investing to a 60-40. It's actually valued relatively the same as a 60-40. So that's what this ETF is. It's roughly a 60-40 ETF. You would probably earn your money back in about 20 years, which is the same time as Texas Instruments. So on a relative basis, fairly valued, but I think the 60-40 is overvalued. So, if I was just going to put my own rough estimates, probably 25% overvalued. It would need to get down to like a 15-year payback period before I would consider that normal long-term, not just my judgment. And then it wouldn't be super attractive until it was like 10 to 12-year payback period, earn your money back faster. So let's now look from an earnings basis. So this uses a similar process, but instead, and you can see I have the same earnings growth rate here, but instead of using dividends, I use earnings. Now, when we go through this process with earnings, I'm not going to go through the entire detailed process because otherwise this video is going to be an hour long to go through every process. But when I do that using that $5 earnings this year, it's really going to make it look really overvalued. And this can be one of the problems when because really those earnings have fallen about 45%, or at least the earnings estimates have. So that's getting kind of into the cyclical territory where this earnings method doesn't work very good, which is what I was talking about earlier, which is almost why the dividend method works better for these guys. But I do also have another method that kind of tries to take into account the bust. You can see I have boom bust here, and I've adjusted it for the boom bust. That could be some of the other metrics that I've adjusted, but it basically measures things from the top of the boom. and it goes back in the past, it would say, okay, how did Texas Instruments do back in 2008, which is what I talked about earlier. And without getting into each individual step of the details, which I have covered in different videos, but you can see that last time it fell about 65%. So maybe this time we would think, okay, if it got 50 or 55% of its high, then off its highest valuation, then maybe that would be a time to come in and buy if you're not trying to get the exact bottom, just trying to get a good price. And then we saw that it's down, maybe 10% off its high already. So, a little under $100 would make it attractive here. So this would have a margin of safety. This wouldn't be fair value. This would be below fair value. I'm not sure what the price is at. So I said 173. Yeah. So yeah, it would be 45% lower to get a really good deal on it. And probably, like I said, fair value is maybe like 25% lower would be fair value. I'm not sure exactly what that works out to over here, maybe 130, something like that, just doing rough math in my head. So yeah, it's really interesting stock. A lot of factors to consider, especially if you I think my gut instinct is it's just going to be hard for this stock to sell off too much, because there's enough people in it just collecting the dividend at this point that I don't think people are just going to rush for the exits. And they could, which is unfortunate because I would like to buy it. I mean, but at a lower price, right? So it's just one of those where I'm probably not going to personally get the opportunity to buy it because it's probably not going to get the returns that I want. I mean, we can see what it's done since we'll go right into COVID, pre-COVID peak. So it's returned 30. This is the total return, I think. No, total return, it's returned about 45% since mid-February 2020, right before COVID. So let's just look at, that was 45%. We'll look at the S&P 500 and see what it's done. So again, same dates. S&P 500's done 62% since then. So you can see it's trailing the S&P 500 in terms of total return, including the dividend from that point. So if we want to do really well, we have to buy it cheap, and the market just doesn't want to give it to us that cheap probably. But, it will fit, I think, a lot of dividend investors check boxes, and it might do better than the average dividend. The average 3% yield stock will probably underperform Texas Instruments, but I don't limit myself to just those. I just try to find the best of everything that I can get my hands on. So, all right. So hopefully you found this useful. Some things to think about. Some numbers, just rough numbers to maybe think about where I think it would be a good value. If you did, hit the subscribe button, like the video, and if you have any questions, put them in the comment section, and I'll see everybody later.